Good afternoon, everyone. Thank you for joining this webinar. In this webinar, I'll be talking about two new NFOs which we are coming out with. Uh, Both the NFOs start today, which is on December 2nd, and they will end on 10th of December. Both are very differential products, so I'll take some amount of time to explain both the strategies. So do stay tuned to understand what both the products are. The first one, as the slide itself mentions, it is Mirai Asset BSC 500 Dividend Leaders 50 ETF. As the name suggests, this fund is going to track 50 companies from BSC 500 universe, which are consistent dividend issuers and are having high dividend yield also. So not only we are looking at higher dividend yield, but we are looking at dividend consistency also. Right. And when we talk about any portfolio which focuses on dividend yield, basically you get several type of characteristics, right? One benefit is that apart from price return of in stock because of stock price appreciation, you can also look forward to income generation from dividends, right? And that can be very important in phases when price growth is not significant, right? If markets are, let's say, flattish and giving only, let's say, 5-6% return, 2 or 3% dividend yield can substantially and relatively increase your returns. So that is one thing, that apart from price returns, you're also looking at dividend returns also as a reasonable returns generator. Second thing which is typically there is that in the performance cycle, when markets are not doing really well, your portfolio is probably a bit more resilient because you have another avenue of appreciation, which is via dividends. Typically, when you look at companies which declare dividend on the higher side, they have better cash flows, they have better balance sheet, and they have more shareholder focused management. So in a way, probably a more sturdy set of companies in terms of taking care of shareholders via dividend declaration, right? And when we look at globally, dividend yield strategy is pretty popular, right? So if you look at US itself, you'll find that out of $720 billion which are based on dividend yield ETFs, almost $600 billion are in US itself. Then come APAC around $93 billion, and then come Europe around $42 billion, right? And uh, one reason why it is very popular is that they are happy with dividend yield income also, while in Indian investors are not very keen, they are happy because their interest rates are low, while not at that this current point in time, but 2 years back their interest rates were almost around 0% plus now, because and then when you look at dividend yield of certain percentage, they look phenomenally higher relatively. So there was reasonable amount of appetite on the dividend yield based products also in India. When we are looking at AUM of dividend yield focused funds, it has grown to almost 3.8 billion dollars as on October 2025, and this was just around $1 billion roughly 4 years back. Having said that, in India, dividend yield as an investment philosophy has not become very popular because typically we are more focused on chasing stock returns, right? We do not too much focus on dividend yield, and also from funds also, let's say, growth options are more popular than dividend options, and that is also to do with tax implications also on dividend, which are comparatively taxed on a higher percentage than your STCG and LTCG. So that is one factor why uh, dividends are also not very popular. But that doesn't, in a way, remove the fact that dividend can add substantially to your returns. Now, let's first understand what a price return index is and what a total return index is, right? Because we will be talking about PRI and TRI. What you look at CNBC or ET now on a daily basis for Nifty or for Sensex is nothing but a PRI index, which is price return index, right? And it simply tracks the price appreciation of underlying stocks. So, in a simple basis, if all the stocks of Sensex has moved up by 10% from a stock price point of view, Sensex will also give 10% price appreciation. So that is PRI, which is for Nifty right now, it's 20 around 26,000. Now, what is TRI? TRI includes your dividend component also. So while Nifty TRI, a PRI, at the end of October 31st was at 25,323, the TRI was 38,855. So TRI is nothing but total return index, and as the name suggests, total return is price return plus dividend. So, let's say in my previous example, if all the companies moved up by 10% and declare 2% dividends, each of them, so the TRI will moved up by 12%, whereas PRI would have moved by 10%. And that's very important because uh, in indices which where you have stocks which are giving reasonable dividends, the difference between PRI and TRI can be significant, right? And the difference is the dividend yield. So and in ETFs also, and in index funds also, typically you get returns which are corresponding to the total return index and not the price return index. So it's good for you, right? So if total return index has given 12% return, price return index has given, let's say, 11 point uh, 11% return, so you are getting a 12% return because the ETF as well as index funds tracks the TRI. It gives you both price appreciation as well as dividend yield as your return. Now, why it becomes very important? Because I think this slide is will illustrate that fact. Now, let's look at the left most slide. Here, a Nifty 500 PRI, price return index, has generated a return of 13.42%, right? But your TRI, which includes dividend, has generated an additional return of 1.25%. So your total return is 14.67. Let's look at Nifty 100, which is a large cap index. Your PRI is 12.45, but your TRI is 13.79, which implies a dividend yield of 1.34%. So you are saying, wow, instead of 12.45, I'm going to get a return of 13.79. And that is what you get. So just see how important is not only price return, but your dividend return also. So for 12.45, may say 1.34 is additional as dividends. Now look at what we are trying to do at the right most. We have constructed this BSE 500 dividend leaders 50 index where price return is 12.79, and this is uh, past year data, right? We are looking at 12.79 return, whereas your dividend yield for the concerned period is 5.31, and hence your total return becomes 18.10, and your total return which you get is 18.10. So if you are targeting higher dividend yielding companies, your actual returns which you are realizing can be higher and will be higher, but that can be reasonably higher if you're focusing on dividend leaders also. So your returns is PRI plus dividends, and we are focusing on dividends as well. So the intent of this fund is to capture stocks which are giving higher dividend yield and ultimately try to give you higher total returns. Now, I'll just first talk about how this index is created, and we worked along with BSC to create this particular index. So, we are looking at companies which have listing history of at least 5 years, and we are looking at uh, that these companies which have listing history of at least 5 years should have given dividends at least 80% of times in past 10 years or since listing. So for example, let's say a company is listed since last 15 years, so we are looking last 10-year data, and 80% of time it should have declared dividends. And if a company is listed since last 8 years, so we are looking at entire listing history of 8 years, and in those 8 years it should have given dividends at least 80% of time. So then what we are doing is we are first looking at 3-year average dividend yield, and any company which is in bottom quartile, which uh, is in bottom 25%, are getting excluded if their average dividend yield is in that particular zone. Then what we are doing is we are looking at uh, latest dividend yield and 3-year average dividend yield, and using both the components we are selecting top 30 companies based on both the parameters. That top 30 companies with highest uh, 3-year average dividend yield and highest latest dividend yield. So based on both the metrics, we are selecting 30 stocks. Rebalancing is done, or rather reconstitution is done on an annual basis, and top stock is capped at 4% just to avoid stock concentration. So this is what the approach is leading to. Out of 500 universe, which is large, mid, small, we are picking out 50 companies with dividend consistency, because we are ensuring that 10 साल या जब से लिस्टिंग हिस्ट्री है, which should be more than 5 years, you should have declared dividends 80% of times. Last 3-year average dividend yield should be in top 3 quartile, and then final selection is based on annual dividend yield latest as well as 3-year average. So we are not only looking at higher dividend yield but at consistency also, which is very important. So we have picked 50 stocks. As of now, BSC 500 dividend yield is just 1.1%, but dividend yield of this particular index is 3.4%. So almost 3x of BSC 500, or 2x more than BSC 500. Now, I said at the start itself that when you're looking at dividend uh, yields and look at companies which are focusing on high dividends, will typically find them having a good balance sheet, good cash flows, shareholder focused management, etc. And that is also which is coming out as metrics when we are looking at overall portfolio. The return on equity of dividend leaders 50 index is 24% versus 18.8% of PSC 500. When we are looking at valuations also, and which is interesting, is this portfolio is at a lower valuation of 12.3 versus 24.4 of BSC 500. One reason is because this is more PSU tilted, right? It's absolutely no brainer that when you are looking at companies which are giving higher dividend, PSU will find a higher portion of the portfolio, which, to be honest, may make it bit risky also. So while we are talking about dividend yield, always remember that your total return which you will end up getting is component of price return as well as dividend yield also. So while we are trying to maximize dividend yield, price return will also play a key component. So if there is a correction in the portfolio, uh, a higher dividend yield while will suppress it, but if a correction is substantial, that will impact the performance of the portfolio. Even when you're looking at ROA, dividend leader 50 index has a return of asset of around 11.8 versus 7.7 by BSE 500. Now this is very important slide which just illustrates the fact which I'm trying to say again and again. Let's look at 1 year, 3 year, and 5 year performance. Let's not look at 1, 3 month and YTD. Now, on 1 year, as I showed in the previous slide, dividend leaders has given dividend of almost 3.47%. So while index was down by 3.69, your PRI was down by 3.69. Your PRI is flattish at minus 0.22, right? Whereas dividend yield of BSE 500 was only 1.19. Dividend yield of BSE Sensex is only 1.26. Just look at 3 year and 5 year data. When in 3 year, the dividend leaders has given 29.31% return, which is substantially higher than what 500 and Sensex has given. It is, as I mentioned, PSU skewed portfolio also. Good performance of PSUs has helped this portfolio. But what has also added significantly is the dividend differential, right? If you're earning 3% plus more because of dividends, that will also compound, right? And that's why we're seeing a difference between PRI and TRI of dividend leaders of almost 5.69% compared to just 1.4% of BSE 500 and 1.4% of Sensex. So that PRI return of 29.31 for dividend leaders has moved up, return has moved up to 35% for TRI. Whereas for Sensex, it has only moved from 11.38 to 12.78. And this also gets illustrated in this particular graph when we are plotting the indices that if you are looking from December 15 to October 25, we are basically sorts of dividend leader 50. The value is PRI is 3.56. For Nifty, it is 3.28 lakhs, 1 lakh rupees invested. For Nifty, because of dividend, it becomes 3.71. But for dividend leaders, it becomes 5.56. That is the huge advantage which dividend ends up giving to this particular portfolio. Now, looking at periodic performance, won't go much into that. You can visit our website and look at this particular presentation. But 5 year performance of 35.8% versus 21.1 versus of 500 versus 17.6 of BSE Sensex. Reasonable performance, right? Even 2 year looks good. 1 year is pretty flattish. Market has been like that, but lower than Sensex, which has given 7% return. Now this is calendar year data, which we are looking how well this particular index did in 21, 22, 23, even in 2024. 17 and 16 also did really well. Where it fell was 18 and 19, right? And that is also, like I mentioned, that while we are focusing on dividend, underlying portfolio performance is also very important because relatively this is PSU skewed. So if PSU companies are not doing well, if companies which are declaring dividend portfolio, which I'll show in the later in the slide, is not doing well, the overall portfolio performance itself will be stunted. So for example, in 2019, even with a dividend yield of, let's say, 3.5%, your dividend leader would have been flattish, where Sensex has given 15% return. So one should obviously be cognizant of these facts also. Vice versa, when dividend leaders gave a return of 29.6% in 2024, 3%, 3.5% would have made it almost 33% return versus let's say 9.5 plus 1.25, almost 10.75% return by Sensex, which just increases the gap significantly. Again, from a rolling return point of view, things get illustrated really well. BSC, like I showed, that in the long term, dividend leaders has done well. Recent PSU rally also has helped. 5 year performance average return. For 3 year investment horizon, averaged for 5 year is 24.9% versus 17.8% by BSC 500. If you are looking at average period of only 3 years, then 35.3% versus 19.4%. One very important thing is that in last 2 years, 3 years, 5 years, 10 years, it has outperformed all of the actively managed dividend yield funds direct plan. That is really good number. It has outperformed all 100% of actively managed dividend yield funds in last 2, 3, 5, 7 year period. So shows that this method works, and passive seems to be the way to go if you want to focus on dividend leaders. Now I'll first look at the portfolio, and like I mentioned that reasonable amount of companies are PSU centric companies. So that is something which investors should note before investing, right? That this will have biasness uh, pertaining to certain segments, right? So you will find exposure towards PSUs, you will find exposure towards certain sectors like energy, metals, etc., more than what you will find in, let's say, a Nifty or any other broad market portfolio. So that is one risk which you should be cautious of. So while dividend yield is, let's say, 3.5%, but if you are not sure about PSU performing, or let's say energy, commodities, etc., performing, then you should not invest in this portfolio, right? Because if price correct significantly, then dividend will not help you uh, uh, study the portfolio. It will only help to an extent, buffer to an extent, but not if there is a significant drawdown. So then before I go into specific company name, if you look at sectors, dividend leaders have higher exposure towards energy, almost 20% more than Sensex. It has almost 7% higher exposure towards IT, almost 15% higher exposure towards commodities. You look at almost 7% higher exposure towards utility, very less exposure towards financial services, almost 30% less exposure compared to BSE Sensex in financial services, which is significant, right? So this can be a good diversification also, that through this portfolio you have lesser exposure towards things like financial services, higher exposure towards cyclicals, energy, especially, and commodities, and we are focusing on higher dividend yield. So that is something which you can take away from this sectoral comparison versus BSE 500 and Sensex. So if you are looking at a portfolio where you want lesser exposure towards BFSI, you want higher tilts towards cyclicals like energy, commodities, and want to focus on portfolio which is giving having companies with reasonable dividends, and this is the right product. Again, when we look at companies, you can see top names are HP, CL, IOC, Bharat Petroleum, Vedanta, ONGC, Tata Steel, Hero Motocorp, HCL Technologies, ITC, NTPC, Power Grid, Coal India, PFC, GAIL, REC, TCS, Infi, Tech Mahindra, Hindustan Zinc, NMDC, Oil Indias. As I read through the name, you'll see that how differential this particular portfolio is. So weightages are mentioned. We have also mentioned 5 year average dividend yield. Now, I've already talked about it, that this product is for someone who is looking to invest in companies which have strong uh, history of dividend declaration and have higher dividend yield historically, uh, who is seeking to target higher total returns, right, and a portfolio with higher dividend yield. This particular portfolio is tilted towards PSU companies, have higher exposure towards segments like energy, commodity, on the cyclical side, utilities and IT on the defensive side, lesser exposure towards BFSI, etc. So if you are keen on that particular portfolio, right, when you're looking at the composition, you'll see that companies have reasonable quality, lower valuations, and better cash flows, and this ETF may declare dividends subject to availability of distributable surplus and regulatory approval. So that is also one point which you should take into consideration, that uh, if there's distributable surplus and regulatory approvals are there, we can possibly go ahead and declare dividend. So I hope this was clear. I talked about the fact that how significantly higher dividend can create good amount of outperformance in your portfolio over the long run. Imagine 3.5% dividend yield versus 1.25 dividend yield of, let's say, any large cap portfolio. That differential of 2.25% or so will keep on adding and keep on compounding, and that will sorts of uh, result in reasonable compounding due to dividend declaration itself. But keep in mind that total return is a factor of PRI, price return, as well as dividend yield. So when both will do well, that is when your total return will be as per your expectations. So that's it. That's it on dividend leaders ETF. Now we'll talk about the second NFO which we are coming out with, and it is completely different. This is Mira Asset Nifty Top 20 Equal Weight ETF, and this is for people who are looking to take a more safer bet in in Indian equity space, right? So someone who's looking for a more sturdy portfolio than even Nifty 50, looking to only restrict themselves in top 20 names. And also what this particular product does is that it has equal exposure. So you don't have higher exposure relatively towards HDFCs or Reliance, etc. So you can remain large cap centric, and if you can avoid concentration which is there in, let's say, Nifties and Sensex, higher concentration towards top 2 3 names including Reliance and HDFC, etc. You can avoid that and continue to sorts of play a safer bet on Indian markets. Completely depend on how you are perceiving market right now, or how do you want to do asset allocation right now. If you have portfolio which is too risky and you want to add sturdiness of large cap, this is something which you can look at. The NFO starts on 2nd of December, which is today, just like our dividend leaders ETF, and it closes on 10th of December, just like our dividend leaders ETF. Like I mentioned, this particular portfolio, the top 20 equal weight ETF, will consist of top 20 stocks based on free float market cap, right? And imagine these top 20 companies capture almost 46.5% of total market cap, which is significant, right? And these companies are leaders in financials, in IT services, consumer, FMCG, automobiles, telecom, construction, etc. So you are not only investing in just uh, 20 mega cap companies, you are perhaps investing in 20 sector leading companies, right? So that is something which one should also sorts of consider when they are investing in this particular portfolio. This is how the journey has been in last 5 years or so, on how markets have evolved from the market cap point of view of first 20th, 50th, 100th largest companies in terms of the market cap. Now, also one very important point is that typically top 20 companies also will add a sturdiness to your portfolio. So they they will have possibly lower drawdown. Having said that, when we backtested the data, because of diversification, Nifty 50 at times also has lower drawdown when compared to top 20. So when you're looking at absolute drawdown, I think then it becomes a coin toss between Nifty top 20 and Nifty 50 index. At times, Nifty has higher drawdown. At times, top 20 has higher drawdown. While top 20 is invested in top 20 companies, Nifty 50 has more number of stocks and diversification comes into picture, which also assists in the drawdown numbers or having a lower drawdown. Now, when you are looking at companies, like I mentioned, that we are looking at leading companies from financial services, HDFC, ICICI, Axis, SBI, Kotak, Bajaj Finance. We are looking at leading automobile companies, Maruti, Mahindra, and Tata Motors. We are looking at leading IT companies, leading consumer durables, Titan, Telecom, Bharti Airtel, Construction, Larsen Toubro. We are looking at FMCG, ITC, and HUL. Oil and gas, Reliance is not just oil and gas, but it's categorized as such right now. And healthcare, Sun Pharma. So you're getting a sector leading companies. Also, when you're looking at return on equity, top 20 equal weight has better at 20.7 versus 19.8 of Nifty 50. Better return of asset. Also, this is one very phenomenal slide, which just simply highlights that these companies command a significant share of revenue and profit pool in their respective basic industries. So within bank, the percentage of revenue of SBI is 24%, HDFC 17%, ICICI 10%, Axis 5.7%, and Kotak 3.5%. A substantial amount of not only revenue shares and profit share is captured by these leading banks. Even when we are talking about, let's say, L&T, which is just one company just present from construction, while construction only has very limited number of companies. Looking at L&T capturing almost 90% of revenue within this basic industry. Even when you're looking at IT, 32% by TCS, 21% by Infosys, 15% by HCL. So you're looking at a number of almost 68% being captured by three companies from the revenue generated by IT software companies. When you're looking at diversified FMCG, ITC, and HUL commands a significant share of this segment. So when you're looking at top 20 companies, you're looking at sector leaders, companies which are capturing most of the revenues and profits, and you're looking obviously for mega cap exposure, right? And in a equal weighted manner. I think when I speak to a lot of clients today, they, while they want to be large cap tilted, they don't have very positive opinion of couple of larger names. To them also this will sorts of make sense that all 20 companies will have equal exposure of 5% each. Now in top 20, the method is pretty straightforward. Top 20 companies based on free float market caps are selected. Index is reviewed on a semi-annual basis in March and September, and weight reset is done on a quarterly basis. Now these are the list of companies which are part of the portfolio. Very quickly, I think when you're looking at HDFC, Reliance, and ICICI, they have a weightage of 12.5, 12.8, 8.5, and 8.1% respectively. So your top three stocks in Nifty 50 have a weightage of 29 to 30%, which is huge. In top 20, they have weight of 5% each. So they will have a weight of 15% at the time of rebalancing. When we look at bottom stocks, you are looking at Tata Motors, Titan, HCL, Sun Pharma, Maruti Suzuki, Zomato, HUL, all having weightage of below 2%, right? So even if you want to sorts of have an exposure in these companies, the percent exposure is pretty low, whereas in top 20, they have a weightage of almost 5% each. So that is very significant. In Nifty 50, top 10 stocks itself have a weight of 55%. If you're looking bottom five stocks, only a weight of 3%, whereas in case of top 20, it is reasonable. Now, in terms of in case of sectoral exposure, uh, the major deviation is obviously that in case of Nifty 50, oil and gas is 10.1% because of presence of Reliance almost capturing 8.5% weight. In case of Tom Pretty, it is just 5.2%. Financial services weight from 36% is in Nifty 50 is 30% in top 20. So it helps in a way which is surprising in somewhat diversification. So you're not top heavy from portfolio point of view. Your top three stocks does not capture almost how much it was, almost 30% weight. And also from a sector point of view, funnily enough, that you have a reasonable amount of uh, diversification in top 20 uh, itself. Now, when you're looking at performance, you can see that in last 7 years, top 20 has given 16.2% return versus 15.2 by Nifty 50, so 1% alpha. In 10 years, it has given 14.4% return versus 13.7 by Nifty 50, so almost 0.7% alpha on a CAGR basis. Same is true for 3 year, 5 year, 1 year, 6 year, and 3 months when you're comparing with Nifty 50 index. Calendar performance on a year on year basis, it won't be significantly different because ultimately top 20 is a subset of Nifty 50 with, but to be honest, not significantly, not not a significant active share also if I'm comparing top 20 portfolio versus Nifty 50. So calendar wise, you won't see much differentiation, but over a long term it does. And as I mentioned, that if you're looking for a mega cap play, you want to, even with a Nifty 50, you're looking for a safer avenue, you are not, you want more diversified portfolio in terms of stock weights, top 20 is the uh, uh, ETF to go for. From a rolling return point of view also, I think things remain pretty similar. If you're looking at 5 year average rolling return, Nifty 50 is 12.1, top 20 is 12.9, so 80 basis point of outperformance. If you're looking at negative also, so you're looking at roughly a percentage of times Nifty top 20 ETF has greater return than Nifty 50, so almost 69% or so versus Nifty 50. Now, finally, I've already talked about it multiple times that if you want to invest in mega cap companies in an equal weighted manner, looking at sector leaders which capture significant amount of revenues and profits, etc., then this is the product to go for. And obviously, this is a low cost option to take exposure in top 20 companies listed in India. And like I mentioned, that both the NFOs, which is BSC 500 Dividend Leaders 50 ETF, I've covered it in the first part of my presentation. The NFO starts today, ends on 10th. Same is the case with Nifty Top 20 Equal Weighted ETF as well. So that's it from me. I hope I was able to clarify uh, any doubts, provide as much as information for both the NFOs. But if you have any questions, please post it and I will take them one by one. Yeah, so first question is from Saranya. Is the portfolio details of stock where these ETF will invest clearly provided in NFO documents? Share details, please. Yes, Saranya. So you can visit our website, and on the scheme page, you will find the presentation where the list of where this presentation is there, NFO presentation, and in that NFO presentation you'll find a list of stocks along with weights. I think that should be October 31st ending data. For further details, you can even visit BSC website, or you can look at other collaterals which have been published by us. Tushar Paturde is asking, is there any variant which won't declare dividend at all that will make more tax efficient for some investors? So Tushar, like I mentioned that uh, dividend declaration will depend on multitude of factors. It may or may not happen. One is obviously fact that whether we are able to create any dividend reserve. For ETFs, it worked differently, or for passives, it worked differently than typical active mutual funds. So it will be very much dependent on the fact whether we are able to create dividend surplus. Uh, it has a different math. So it is not the case that if we get a 3.5% dividend, we'll be able to declare 3.5% dividend. We also have to look at realized profit, unrealized losses, etc. at the scheme level, and it's a more complicated calculation. So first answer is that for ETFs there is only one plan which gets listed, and for dividend leaders we may or may not declare dividends, but it's a possibility. Yeah, so the third question is from Prakash Tharwani, who is asking how is equal in weights when there is a different percentage investment. So Prakash, I think you are referring to the slide where I showed 20 stocks, but there was minor change. Some were at 5.2 and some were at 4.8%. So what happens is that on a quarterly basis, Nifty resets the portfolio at 5% each. NSE resets the portfolio at 5% each. But between those quarters, you will see that because of mark to market movement, stocks will end up having a higher or a lower weight. So, for example, let's say in last rebalancing, HDFC and let's say Reliance were set at 5% each. Whichever stocks will do relatively better, उसका वेट 5% से थोड़ा बढ़ जाएगा, एंड जिसका विच विल डू रिलेटिवली पुअर उसका वेट 5% से थोड़ा कम हो जाएगा. दैट्स नथिंग बट अ मार्क टू मार्केट मूवमेंट. So yeah, so there's one question: how top 20 ETF can be compared with some other AMC's top 20 index fund. So uh, while I cannot take the AMC name, I think you're talking about one AMC which has similar scheme. So I think portfolio tracking will be similar, but this is an ETF will be listed on stock exchange. And perhaps one difference can be the TER of index fund versus the ETF. So you can check that and take the call accordingly. So NFO details, Sandeep, can be found on our scheme, our website itself on the scheme page. So Parag is asking, is there any hedge mechanism? So there is no hedge mechanism. Jitendra is asking, I think he's just saying ETF for Nifty 20 top. Yes, that is what it is. Raghotam Kulkarni is asking, what is the entry load for NFO ETF or only STT is applicable? So Raghotam, there is no entry or exit load for ETFs. Sandeep is asking lump sum or SIF, which is more preferable for these NFOs. I think at this point in time, you can opt for either lump sum or SIP, but if I have to pick one, I think SIP will be preferable. What When are these ETFs getting listed on exchange? So it will get listed within 5 working days from the date of allotment. So Jitendra is also asking one more question, which is silver ETF will give dividend. No, silver ETF does not give dividend. In fact, most of the ETFs, majority, significant majority of them, does not give dividend. So Nitin Pradhan is asking, what is the frequency of portfolio adjustment? I mean, addition, deletion of shares. So while you have not mentioned uh, mention which index you're talking about, for BSC dividend leaders, it will be on an annual basis in December, and for Nifty Top 20, it will be semi-annually in the month of March and September. So dividend will be declared in form of cash and not in form of units, most likely. So whenever there's any, if we end up declaring dividend, you will get the information accordingly. So there's one last question which is not related to this NFO, but I'll take that because we have time. So Saranya is asking, there's a commentary that the international ETF have large tracking error between ongoing prices and actual value of underlying asset. What can be done about it, please? So Saranya, uh, thing is that that theoretically there's no significant tracking error. If you look at funds NAV, which is net asset value, and which is in INR, and convert the international index into INR value, and then compute the tracking error, you'll see that international ETFs are tracking the index well. In fact, our FANG ETF tracking error is pretty good. What you are referring to is the fact that the prices on the exchange is trading far away from NAV, right? So in fact, the trading price of, let's say, a FANG ETF is roughly 15 to 20% premium higher than what the NAV is, and that is because of supply and demand, because of regulatory restrictions. We cannot create additional ETF units in our international ETFs, so I cannot supply on the exchange via my market maker. So whatever units are already existing in the markets, they are trading at a significant premium because of demand for US tech companies and Chinese companies, and hence Hang Seng Tech is also trading at premium. So that is what is being referred to as tracking error, or trading at a different price than what index value suggests. But that is not controllable by the AMC. But if you look at proper NAV, which is the valuation of the ETF done on a daily basis, and compare that with the INR value of the index, you'll see that tracking is pretty good for at least our international ETFs. There's I think two, three more questions. Very quickly, I'll take it. So dividends are, there's one question by Dayanand. So dividends, if they are, so for top 20 ETFs, dividend will be reinvested, right? Like in case of all our ETFs. For dividend leaders, they will be reinvested, and if we have distributable surplus, if regulation permits, we may declare dividends, which will get credited in your account. So taxation is as per equities for ETFs as well. That was a question by Ashutosh. Uh, Just one last question from Rajesh, and then we'll close the session. Rajesh, yeah, silver ETFs are now not trading at premium. Inventory issues as of now seems resolved. So that premium concern around silver ETF is currently not there. So thank you so much everyone for joining this webinar. If you have any more questions, uh, please contact us through social media channels. We'll be happy to clarify uh, as much as possible, or contact us through your RM. So I hope I was able to clarify and provide more information about both the NFOs. I hope you like both the offerings, or at least one of the offerings, and if it fits in your overall portfolio, in your risk profile and investment objective, we look forward for your participation in these two NFO. Thank you. Have a great week ahead. Goodbye.